more interesting from the investment point of view.
Okay, all right. Just stay on, Deven. We'll come to you in just a few minutes from now. Now, global markets are in focus. Oil has risen once again as Saudi Arabia plans for an output cut. So Brent is at $100 a barrel. Also, there's a 3-day Jackson Hole Symposium, which starts tomorrow. And there's an expectation that post that, Jerome Powell in his speech could reiterate the fight on inflation. All of this means that there could be some impact on metals, on gold, oil, etc. Juerg Kiener, the Managing Director and Chief Investment Officer at Swiss Asia Capital, joins us now to talk about that. You, good morning and thanks for joining in. First on crude, once again, at $100 a barrel on Brent. What are your thoughts and what is the expectation as we move along?
You see, I think most commodities, including energy, have actually done a significant correction since May. And we always thought about $70 to $80 would be the bottom on energy. I think 80 was just about the bottom, and it started to reverse on the back of the Saudi announcements. I think people are getting too much hooked up on all the stories of interest rate increases and strong dollars. And so the futures market is driving very big yo-yos, whilst actually regional issues on getting access to that material at the same price is almost impossible.
So, right. So what does that mean? I mean, so in a way you're kind of agreeing with what we heard from the Saudi Arabia energy minister, that there's a big disconnect and prices need to adjust much higher?
I think I more or less agree with what he's saying. I have to specify that because, as you know, oil prices are swinging depending where you are in the world, depending what your infrastructure and logistics right now is. So we've got very big dislocations. So probably people who get oil at significant discount to the $80 we are today. And there are probably some people who pay significantly more due to logistic issues. So the spread is actually quite big, and therefore the futures market is not really representing actually what's happened on the ground on the end for the end consumers.
Where should oil prices be to accurately reflect demand? One, and two, the other view is that maybe demand is slowing much faster than any, the supply issues are affecting prices. So that's the other view. Yeah, go on.
So if you actually look at the price, we're actually at the price level prior to the Russian war. And so basically, you can actually say all the hype we actually been built up in the price has actually disappeared. In the meantime, what we have is a slowdown of the economy, particularly in the United States. Whereas if you look at the Chinese economy, it's been pretty weak, but there we have already seen stimulus. So the question is, how much more can U.S. actually tighten in that environment where the dollar is already getting reasonably strong towards 110? And I think at the price level, probably people will start thinking a slowdown on tightening might be in the card, particularly as the recessionary environments are actually appearing almost everywhere around the world.
Good morning. So actually, that's an interesting point you made because a lot of countries getting oil at a discount, like India gets from Russia, and a lot of countries having to pay the premium. So is this price on the screen relevant at all? I mean, what should one look at then?
To be honest, I think you can probably as well look at the future price for tomatoes, and then you go and buy your tins of tomatoes and the price will be all over the place. So go to a wet market and you can buy probably tomatoes at very different prices depending who sell it to you. And I think we've been used in the past that this gap was actually really narrow. And in today's environment, actually, these gaps are huge. They are almost like from bottom to top, they're probably double. So what we have to see is that these things is tightening up in order for a future market to even be representative.
But coming back to what's happening in Europe, it is a big crisis, right? The energy crisis in Europe. I mean, we've seen the euro hit at 20-year low. There are high temperatures. There's a drought situation which has hit the power supply in a big way. How does this change the dynamics from an investment standpoint? Will there be more money moving towards emerging markets, towards Asian markets because of the crisis that we're seeing in Europe?
I think you might get capital flow leaving Europe and Japan because basically we still have zero interest rates in a rising inflation environment. So that's a risk. You have an energy crisis and the food crisis around the world, despite that if you look at grain prices have almost retrieved to pre-crisis level. So I think what we have now is that the financial markets are discounting now recession in the commodity space. whilst actually low inventories and problematics we have on the ground might actually prove that by next year or by later the year, we are actually moving back into a shortage crisis. And we see that by backwardation, we see it on the curve, we see in delivery issues. So commodity prices will probably go up again for end users. I have no clue where the future market will be, because the future market is basically a financial instrument by bankers, has nothing to do with the real economy.
Juerg, what's your view on what's happening in China in terms of what a lot of people are calling some kind of an economic crisis, and what kind of an impact would it have on asset classes?
So look, if you look at China, we have basically a real estate problem and probably going to get some defaults in that segment. But then on the other side, we've got one of the largest booms when it comes to technology. And if you look at new technology, electric vehicle, electrification, I think the capital investment cycle in there has gone up over 30% year on year. So what you have is actually a part of the economy which is in dire straits, and the other part of the economy is growing really fast. And the government is stimulating the economy of the future and tries to support the wind down of the old part of the economy which is in dire straits. So I think as such, if I listen normally to North American commentary, it's all bad. Nobody talks actually about what moves up. And if you look at the GNP, is actually not contracting, it's actually reasonably firm. And so from that point of view, that's what you would expect in a stagflation environment, is a transitional shift from A to B. And you see that probably almost everywhere else emerging. I think in the United States, you see the same. You have probably as well a property market crisis in some areas. And in other areas, you actually have shortages on property, and you see the government coming out with critical mineral policies in order to build up the next level of electrification. It's where you want to be. It's actually where the areas which are growing, you want to be investor, and not necessarily the areas which are suffering headwinds.
Juerg, I mean, if you're up for it, just a quick rapid fire. What is the right level for oil prices in your assessment?
I think you'll probably have a very good bottom building. I think your risks are on the way up. And if these future markets are starting to cover up the shorts, your risk is that the commodity market is going to be a new bull market. And if you look at the new bull market, your oil price are probably finding levels somewhere between $150 and $200. So your risk-reward structure is probably in favor of higher prices.
$50 to $200.
$150 to $200.
That's the right range, somewhere there. And
no, that's the higher end range, and the bottom end range, I'm looking somewhere around 70 to 80 as a support.
No, you said the reason I'm asking is you said right now the paper market is not accurately reflecting what's happening in end user demand. So prices need to adjust higher. So what is that higher is what I'm trying to understand.
When people are excessively shorts, when traders are really excessively shorts, and you can look at the whole base metal universe, backwardation is enormous. You can look at the precious metal universe. We have backwardation only for 3 months, where people having to wait 3 to 5 months for significant deliveries. You know that the price will have to move up in order to square that level. The question is how many shorts will have to cover, and how high has the price got to go? I don't know. Certainly higher. And you know, when shorts have cover, you get speculation coming back in, who play the other side and pushing the prices higher. So we're going to get probably from an oversold level to an overbought level, and that means normally you have a fair good chance of prices to move for 30 to 50%. It's no big deal.
Okay, well, Juerg, we'll leave it at that. Thanks a lot for joining in and giving us your view across asset classes. Have a great day. Let's slip into a quick break. On the other side of the break, we have 15 minutes to go for the pre-opening rates to kick in. Nitesh Thakkar and Sudarshan Sukhani will join in for some technical trades. Stay tuned.